Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. We're excited to discuss maximum 2025 after-tax solo 401k contribution limits. This relates to the mega backdoor Roth solo 401k. If you have questions or topics you wish to discuss, please chat over your questions or topics, whether on this topic or even off-topic issues, as we want to discuss issues as well if you have questions. But we do want to go through these topics as well, so we'll get started with this topic. But again, feel free to chat over questions or topics, and we'll go through things sequentially. So again, welcome to discuss the 2025 after-tax 401k limits. The presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Here's what we're going to cover. We're going to talk about the solo 401k structure, the 2025 limits, after-tax strategies, and the mega backdoor Roth. Please, again, thank you so much for joining. Feel free to chat over your questions. We'll go through those in a moment. We're just going to go through these slides. What is a solo 401k? It's a self-employed retirement plan for self-employed individuals. So the key is that you're self-employed with no full-time, non-owner, non-spouse, W-2 employees. So it's for an owner-only business. Now, with the solo 401k, it has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because, in simple terms, you're both the employee and the employer. You wear both hats, so you can make both types of contributions. That's why it has the highest contribution limits for any defined contribution plan available to self-employed individuals. So those contribution types that may be supported are going to depend on your plan documents. But if you've got a solo 401k plan for My Solo 401k Financial, then you're going to have the most contribution types that are allowed under the rules that are supported under your plan, because our plan supports them all. So you've got employee contributions, either pre-tax or Roth, employer contributions, so not matching contributions, but what they call profit sharing contributions. Now, technically, these can also be made as Roth, although historically they were always made as pre-tax. But in simple terms, most customers who are trying to maximize Roth contributions would skip making employer contributions and instead just simply make after-tax contributions. But technically, yes, our plan does allow for employer contributions to be made as Roth contributions. And then the last type, which is the focus of this webinar, are voluntary after-tax contributions. These are technically not Roth contributions, so they need to be deposited into a separate sub-account. But if your plan allows it, like ours does, you can transfer the voluntary after-tax solo 401k contributions either to a Roth IRA or a Roth solo 401k. So now let's get to the limits, because again, we want to discuss those maximum 2025 after-tax solo 401k contribution limits. So for 2025, the overall limit is $70,000. Now, if you're 50 or older, you can make what's called a catch-up contribution, which for 2025 is $7,500, $7,500. But for 2025, they've now added a super catch-up contribution limit. So if you're age 60 to 63, instead of $7,500, you can contribute $11,250 on top of the 70, assuming that you have got the self-employment income to justify the contributions, bringing the total potential contribution limit to $81,250. Now, it's important to note that the voluntary after-tax contribution limit does not increase with age. So you can still make those additional contributions, but you wouldn't make them as voluntary after-tax contributions. They'd have to be made either as employee Roth contributions or employee pre-tax contributions. So that's how those catch-up contributions are made. So let's break down the 2025 solo 401k contribution components. So you have the employee contribution limit, also known as the elective deferral limit, which for 2025, so you got the overall limits, which we were looking at in the prior slide, and then you've got limits for the different buckets, so these sub-limits. First bucket is the employee bucket, also known as elective deferral. For 2025, it's 100% of your compensation, dollar for dollar, up to $23,500. But if you're 50 or older, you can make the catch-up contribution. As I just noted, that's going to be made as an employee contribution. So $7,500 if you're 50 or older, or instead of $7,500 if you're age 60 to 63, it's $11,250. Now, this limit applies at the employee level. So if you've made contributions to another plan, like a day job plan, it reduces how much you can contribute as an employee contribution to the solo 401k. Second bucket, as we break it down, is the employer profit sharing bucket. Now, this is going to be a percentage of your compensation. And the percentage amount depends on how your business is taxed. If your business is taxed as a sole proprietorship or a partnership, it's 20% of your compensation. Compensation for a sole proprietorship is your net income reported on line 31 of Schedule C, less 1/2 of the self-employment tax. So you got to run that pre-calculation. And then of that amount, you can contribute 20% as an employer contribution, assuming that the total amount of contributions don't exceed the lesser of self-employment compensation or the overall limit. For a partnership, self-employment compensation is line 14 of the K1 less 1/2 of the self-employment tax. So again, you got to run a pre-calculation. And we have a calculator on our website that'll run that calculation. We also help customers every day understand these rules, help them run the numbers. Now, in the case of a business that's taxed as an SCorp or a C-Corp, it's 25% of compensation, where compensation is equal to your W-2 wages from the SCorp or the C-Corp. Finally, you've got the after-tax contribution limit, which is 100% of self-employment compensation, dollar for dollar, up to the overall limit of $70,000, but reduced by any employee or employer contributions that are made to the plan. So you still got to consider that overall limit. But when you're reducing it by the employee limit, employee contributions that are made to the plan, you can ignore the catch-up contributions. So you can still effectively get to the higher amounts because you can ignore those catch-up contribution amounts. So the other piece to recognize is the 403B limit, the 403B exception to the multiple employer contribution rules. So as I noted, the employee limit applies at the employee level. So that means that if the employee, you are making contributions to another plan, like a day job plan, it reduces how much you can contribute as an employee contribution to the solo 401k, but it's not going to reduce how much you can contribute as an employer or as a voluntary after tax. That's the general rule. The exception to that general rule is the 403B exception. So contributions made to a 403B, whether employee or employer, together with any contributions that you want to make to the solo 401k, the sum cannot exceed the overall limit. So that gives us an overview, a quick overview of how those work. And we have deep experience. We provide tremendous support in helping customers apply those rules to their situation. But it's good to start to understand it. Now let's focus in on after-tax contributions. So what are after-tax contributions? Well, they're a type of contribution that's made with post-tax dollars, in contrast with pre-tax contributions. So when you make pre-tax contributions, you reduce your taxable income. Whereas if you make a Roth or an after-tax contribution, you're making it on an after-tax basis. So you don't receive any income tax reduction benefit for the year for which you make the contribution. But once the funds are in that after-tax account, they can be converted over to a Roth solo 401k or a Roth IRA. Now, it is not a Roth 401k contribution. That's why it needs to go into a separate after-tax account. But if the plan allows it, like ours does, those voluntary after-tax solo 401k contributions could be transferred to a Roth solo 401k or a Roth IRA. So now you got the potential for tax-free growth. Here comes the tax benefit. Just like any Roth 401k funds that you might have in your solo 401k account. The benefit is the potential for tax-free growth, because the gains are going to be tax-free if at the time you take a distribution from your Roth solo 401k, you take it as a qualified distribution, meaning you've had the account for at least 5 years and you're at least 59 and a half years of age. So let's again go through that after-tax contribution limit, because we want to understand the maximum 2025 after-tax solo 401k contribution limit. So the limit is 100% of your self-employment compensation. In other words, it's not a percentage like the employer contribution limit. It's like the elective deferral. It's like the employee limit. You can contribute dollar for dollar, 100% of your self-employment compensation up to the overall limit. But you still have to consider that overall contribution limit. So the sum of contributions made to the plan can't exceed the overall limit. So if you contribute $50,000 between employee and employer, the most that you can contribute as an after-tax contribution is another 20, bringing you to 70. Let's go through some examples to help paint the picture to see how these rules work. Let's assume that the individual is self-employed, they're under 50, their business is taxed as an S corporation, they receive $100,000 of W-2 wages from their S corporation. For 2025, they contribute $23,500 as a Roth employee contribution. They contribute 25% as an employer. So now they can contribute the rest up to $70,000 as a voluntary after tax, another $21,500. Let's go through another example. Now let's lower the compensation, still under 50, but instead of $100,000, they have $60,000 of W-2 wages. Let's assume that they don't make any employer contributions, because their goal, let's assume, is to maximize the funds that'll end up in their Roth solo 401k. They contribute 100% dollar for dollar of their wages as an employee contribution, up to $23,500 directly to that Roth solo 401k account. They skip the employer, and then they just do the difference up to $60,000, so $36,500 as a voluntary after tax, and then move that over from the after-tax solo 401k to the Roth solo 401k, bringing the total to $60,000, because you can't save more than you earn. So remember, this illustrates the point that the limit is the lesser of self-employment compensation or the overall limit. So you can't save more than $60,000 or more than you earn. So now let's finish up with a third example. Now let's assume the individual is 55. They have $150,000 of W-2 wages from their self-employed business taxed as an S corporation. So they're going to be able to make that catch-up contribution, $7,500, in addition to their $23,500. Let's clean that up real quick. So that means that their total going in as a employee contribution is $31,000. Let's assume that they skip the employer. They're not interested in making pre-tax contributions, only interested in maximizing the funds that go into the Roth. So they can contribute another $46,500 as an after-tax. Remember that this is a great illustration of how the after-tax contribution limit works, right? So you can contribute 100% dollar for dollar up to $70,000, but reduced by those employee contributions and employer. Here, there's no employer contributions made, but reduced by the $23,500. But you can ignore the catch-up, right? So you can't make the catch-up contribution as an after-tax, but you don't have to reduce how much you can contribute as an after-tax by that catch-up contribution. So effectively, you can still make the $77,500. So that's why the person's able to make another $46,500 as an after-tax and then move it over to the Roth. So at the end of the day, they're still going to have $77,500 in their Roth solo 401k between employee, catch-up, and voluntary after-tax. Now, the whole foundation is you need to have a plan document that allows you to make these contributions, voluntary after-tax contributions, and then allows for the in-plan conversion over to the Roth solo 401k or the in-service transfer out of the voluntary after-tax solo 401k account to the Roth IRA. And obviously, and of course, the plan documents that we offer support this, right? Because that's one of the top reasons that customers sign up with us. So the benefits of voluntary after-tax contributions are now you can end up with more money in your Roth account. It's higher than the Roth contribution opportunity if you're contributing directly to the Roth 401k. Obviously, much higher than a Roth IRA, 10 times higher. Then once the money's in that Roth account, you got that potential for tax-free growth. And unlike a Roth IRA, where there's limits, there's income limits on how much above which one cannot make Roth IRA contributions. In other words, if you make too much money, you're not eligible. You're not allowed to make a Roth IRA contribution. But there are no such income caps on your ability to make voluntary after-tax contributions to the solo 401k. All right, wonderful. That takes us to the end of the slides. Thank you so much for joining. If you found that to be helpful, please like this video as it helps us to get the word out to other self-employed individuals just like you, other solopreneurs. We really appreciate that. Please subscribe as we do go live every day. If you subscribe, you'll get notifications. You can join, ask questions, just hear the content that we come to share. You can also join our community, mysolo401k.net/my community. We have forums. We have a library of videos and webinars. If you email us at business@mysolo401k.net, we'll give you access. Make it easy. All right, let's go to the questions. If I made an investment from my Roth Solo 401k account, and when I get the return back, if it went into my other Solo 401k account, which that's not correct, those returns need to flow back to the Roth Solo 401k account. Can I just have it transferred over to my Roth account, my brokerage, and that would be okay? Well, it's definitely not the correct procedure. There are individuals in that situation that would make a reasonable decision to move over the gains to the Roth Solo 401k, of course, accounting for any gains or losses that accrued on that portion that was deposited into the pre-tax account before moving it over to the Roth Solo 401k. And then just making sure they're putting steps in place to ensure that it's just a one-time exception and doesn't happen again. Good question. I purchased a couple properties in 2024 with my solo 401k. Rehab is almost completed. I'm hoping to refi and cash out to my plan. Do you have any suggestions on where I can find non-recourse loans for these properties? So there are a list of companies on our website that do provide non-recourse loans to retirement accounts, including solo 401k plans. Let me see if I can grab that link real quick. Keep in mind that there's an exception to so generally when you have investments in your retirement account that are debt financed, those investments, the income attributable to those investments is going to be subject to a tax called unrelated debt finance income tax. Now, there's an exception for leveraged real estate in a solo 401k. But the language of that exception, and here's that link that I was mentioning, the language of that exception provides that it would be real estate subject to acquisition indebtedness. And so if someone's refinancing a property, that may not be considered acquisition indebtedness. So you would definitely want to discuss that with your tax advisor to see if that's going to trigger unrelated debt finance income tax payable by the solo 401k. Doesn't mean that it's prohibited. It just means that the 401k may need to file a tax return and pay taxes. Do you need an SCorp to be able to contribute the most money to your solo Roth 401k? Or can you simply be self-employed with an LLC? Oh, yes, it's totally fine. One's ability to set up a solo 401k is not determined by how their business is taxed, and the income limits, the contribution limits are going to be the same. You can make Roth 401k contributions based on a business that's taxed as a sole proprietorship, like a single member LLC or an SCorp. Now, the details and mechanics are going to differ. As we went through those slides, we showed how we talked about at one point about how your ability to contribute is based off of self-employment compensation. So for an SCorp, self-employment compensation is the W-2 wages that the individual receives, whereas for an LLC, where it's taxed as a sole proprietorship with the income flowing to Schedule C of the 1040. It's based on self-employment compensation, where self-employment compensation is line 31 of Schedule C, less 1/2 of the self-employment tax. And then the employer contribution calculation is also going to be different. It's 25% of the W-2 wages in the case of an SCorp, whereas it's going to be 20% of the self-employment calculation, that self-employment calculation figure, right? The line 31 of Schedule C, less 1/2 of the self-employment tax, and then 20% of that figure would be the employer limit. So how you determine compensation is different. The percentage that applies for determining how much one can contribute as an employer contribution limit is different. But you can still make Roth contributions regardless of how the self-employed business is taxed. The limits are still the same, etc. Good question. Right. So it sounds like it would be a bona fide error. Well, basically, what individuals would do based on, just to give an educational response, just sharing feedback for educational purposes, is others have made a reasonable decision to move the money to correct the error, right? To move the money to the account that it would have been, that it should have been sent to, and to put that account into the same place as if it was sent there from the beginning. That's why individuals will account for any gains or losses that accrued on those funds when they were in the wrong account, because then that puts that money, that puts that account in the same place that it would have been if it had been sent to the correct account, and then taking steps to ensure that it doesn't happen again. Hopefully that helps. Let's say I want to buy a $500,000 property and use $100,000 for my solo 401k. Is this possible, or would it be subject to the tax you mentioned? So the resources would be the non-recourse financing page. We also have, of course, a real estate page. Let me pull that up. So there's an exception to the unrelated debt finance income tax. So that's the tax that applies when there is debt financed investments in your retirement account, and there is income that flows from that investments. So think like margin stock, right? Buying stock on margin is a debt financed investment. And the courts have ruled that income from stock that was purchased on margin that's inside a retirement account is subject to UDFI, unrelated debt finance income tax, payable by the retirement account. But there's an exception to that UDFI tax with respect to income that flows from debt financed real estate in the solo 401k. And the language of that exception discusses how the real estate is subject to acquisition indebtedness. So with respect to the example you presented, it would be possible to avoid that tax if it's structured properly. Now, with regards to the numbers that's presented, based on feedback, experience, client feedback, as well as feedback from the lenders that are in this space that lend to people's retirement accounts, is because it's a non-recourse loan, that means the only recourse of the lender is the underlying collateral, the property itself. So it's typically going to be priced much differently. For example, they'll often want 50% down, because again, their collateral, their only recourse is the collateral, as opposed to the numbers that you presented. Hopefully that helps. So again, yes, please like, please subscribe so you can get notifications of when we go live. Thank you so much for the great engagement and the great participation. We'll give it another moment to see if there's any final questions. All right. Well, take care, everyone. We appreciate the opportunity. Till next time.